Ladies and gentlemen, please welcome to the stage a moderator of our next panel, Steve DeRose.
Hey, thanks very much. Great to be here, and always obviously love seeing everybody in person at our storage trade show conferences. But I guess this is the next best thing in today's world, and how fortunate we are that given the circumstances, we're able to have the technology to be able to do this. So we're excited to be here. My name is Steve DeRose, and I'm with Starwood Mortgage Capital. I'll be your moderator today for this panel, which is financing self-storage in today's environment. I'm also joined by four others, Shawn Hill from BSC Group on the mortgage brokerage side, Terry Campbell from Live Oak Bank, who focuses in the SBA side of the lending business, Nick Collins from Bank 59, who also does SBA lending on the banking side, and then Dan Hryczyk from the CFO of Metro Self Storage. So we welcome you here today, and looking forward to having a chat about a very obviously important topic, especially in the midst of coming out of the COVID-19 crisis. We'll give a little bit of introductions first. So for the audience, so that you know, my background is I'm on the lending side. Starwood Mortgage Capital is the largest non-bank CMBS shop in the business. We do loans on all property types, but have always had self-storage close to our heart, and we've done quite a lot of it over the course of the last decade in particular. Turn it on over and let's make introductions to have everybody else make their introductions and give you a little bit of background on themselves. So Shawn, why don't you take it away?
Thanks, Steve. Good morning. My name is Shawn Hill. I am a principal and co-founding member along with Devin Huber of the BSC Group. We are a mortgage banking, debt and equity shop with a specific expertise in self-storage. That is the asset class that we spend 95% of our time in. So we are the guys that you hire to go out and find you a loan, help source debt and equity for your self-storage deals. And we have been in the business, the BSC Group had our 10-year anniversary in 2019. And I have been in the banking business in various capacities with Fitch Ratings, Wells Fargo Bank, and prior to the BSC Group with a company called Beacon Realty Capital for going on 20 years. So thank you for having me.
Great. Terry.
Steve, thanks. Good morning, everybody. I'm extremely happy to be here. I have been in the self-storage industry a little over 25 years myself. The first 20 years, actually, I spent with one of the major self-storage building manufacturers, supplying buildings into the industry. While there, I helped to start the North Carolina Self-Storage Association, which I'm still actually a board member on currently. And having mentioned that, I would encourage anybody who's not a member of your state to check it out and think about joining. I grew up in this industry there. I started here at Live Oak Bank about 5 years ago, a little over 5 years ago. And I'm a partner in 4 facilities. So I see it from both sides, not just a vendor and a lender, but also from an owner as well. And our team here, the way that Live Oak works is every industry we have, there's one team that focuses on that, so we'll get really good at it. We're at Live Oaks, the #1 SBA lender in the country by dollar volume. And for the last 4 years, our team has actually won 4 years in a row. We won the ISS Best Lender of the Year award. We're very proud of that, and we love to help our customers.
Great. Thanks, Terry. Dan, why don't you give us an introduction to yourself and to Metro?
Sure, thanks, Steve. My name is Dan Hryczyk. I'm the CFO of Metro Storage. I've been with Metro now about 13, 14 years and in the industry for that same period of time in self-storage. Before that, I was with General Growth Properties and Equity Office for about 8 years between the two. Within Metro, I oversee all of our revenue management function, the accounting function, and the finance function, including the debt placements, which is, of course, relative to this conversation. For those of you not as familiar with Metro, Metro currently manages about 140 stores across 14 states and about 9.3 million square feet.
Great, thanks, Dan. And last but not least, Nick Collins. Nick, give us an overview on yourself and Bank 59.
Nick Collins. I'm a commercial lender at Bank 59. We recently went through a name change. We were First Bank Financial Center, but we rebranded. We've been a locally owned and operated community bank since 1859, but we are a nationwide SBA lender in both the 7A and the 504 products, and I've been specializing in that for self-storage financing for the last 10 years.
Great. Awesome. Thanks. So guys, let's jump right on into it. I guess, for take it from the top and give all of our participants today a little bit of an overview. Obviously, there are, different types of loans, and depending on where what stage the property is in, that oftentimes makes the determination of what type of loan you're looking for here. So why don't we give an overview for everybody with a little bit of background on what those different types are. Let's start. I always think of it as three main buckets. You've got construction financing. Once the construction component is done, and then there's the lease up stage. There's I'll call it bridge financing as the next component, and then once the property has been stabilized, there's permanent financing that you can move into. So why don't we talk a little bit for a second and break down and talk about the different types of options that are out there. I guess let's start with talking about construction financing. And Nick, I'm going to turn it on over to you. Why don't you tell us about, give us the overview of construction financing, particularly in the SBA program. I believe the 504 loans are the ones where that would fit into from an SBA perspective. So why don't you give us just talk briefly about 504 and then, bank financing, a traditional bank loan as well for doing construction.
So I'm going to touch base on the SBA 504 program today, which has become a very popular program within the SBA products. And what we can do with the 504 is we can finance both the construction process, including the land purchase, the interest-only period, and then it will ultimately roll into a permanent product. So it's a one-stop shop within one loan program. A little bit about the program is you can do facilities over $5 million with the 504, where with the 7A, there's a $5 million cap. The program allows you to do more than one over $5 million product if you do a green project. So for those of you doing conversion or new construction with climate control, if you get a 10% energy savings through solar panels, HVAC, some type of construction savings, you can do unlimited amount of deals over the $5 million cap, we're told. The real benefit of the program is the end result. Once you receive certificate of occupancy, the CDC portion, which is typically 35 to 40% of the overall debt, is a 25-year fixed rate. And as of today, it's around 2.6. So as opposed to smaller, under $5 million deals with 7A, most banks do floating rates. You get more of a fixed component to the 504 package.
And so, Nick, just to go back on something that you had mentioned, it's a one-stop shop program. You mentioned that after you're done with the construction, it can roll into a permanent financing. Is that where it transitions then into the 7A program?
Well, the 7A and the 504 are separate programs, so it would stay at 504.
Separate programs. Okay. Well, while we're talking about SBA, I'll switch to Terry Campbell. Terry, since you're also in the SBA field in the lending arena, why don't you tell us a little bit about the 7A product for a second?
Sure. The 7A actually is used a lot for construction as well. Over the last 5 years, we've done about a little over $640 million in self-storage financing. The majority of that has actually been construction, and the majority of that has been the 7A program. As you heard Nick mention, there is a $5 million cap typically on the loan, and different banks like we will do this. We'll do what we call a pari passu loan to go along with that 7A loan to get you over $5 million if you need to. And the reason we like 7A for our customers, and I'm going to back up just a second and say that both of these programs are great, and it's incumbent on the lender to do a good job by working with the borrower to determine their needs, their goals, their situation, to see which loan is the best. Sometimes it is a 504, sometimes it's a 7A. But with the 7A, one of the reasons we really like it is because you can finance in the working capital and the interest-only payments through lease-up as well in the 7A, and it's going to be amortized over 25 years, where you can also use the 7A with a 504, but it's going to be compressed down to a 10-year term typically, and it's going to affect your cash flow. So that's one of the reasons we like it the most for construction, but we have done both, and we will do both, and it depends on the customer. But some of the great things about the 7A program is as little as 10% equity is required to get into it. There's no financial covenants, no balloons, no calls. It is a 25-year fully amortizing loan. It's up to the bank. It can be variable. It can be fixed. We're probably doing more fixed now than we are floating, and almost everything is fixed these days that we're doing. And another major reason we like it is we know that a lot of times when these things are built, they're going to want to change over or sell or flip. There's different reasons they're going to want to get out of it. And it's only a 3-year prepayment penalty versus a 10-year on the 504 program. But those are some of the things that we like about the 7A for construction. But again, they both have their place, and it's our job as lenders to determine what is the best for that borrower in their particular situation.
And Terry, before we switch gears, just give us an idea of where are rates today for the 7A program with SBA.
The rates vary. Unlike the 504, the part that the SBA funds, the debenture with the 504 is set by the SBA. With the 7A and portions of the 504 are both set by the bank. So the rates are going to be determined by the deal itself, the strength of the deal, the borrower, their credit. So it's hard for me to say, this is what the rate is, because it can vary. And I don't like to hem myself in a corner by giving a rate until I've seen the whole deal. Okay.
Switching over to Shawn, once if you're not going to go, if you're a borrower that's not going to go the route of doing an SBA loan, tell us about give everybody an overview of bank loans and bridge loans and what optionality there is there.
Sure. Well, on the construction side, obviously, in addition to the SBA, which has proven to be a very compelling product over the last several years, the traditional source of construction financing is local bank financing, and that is where the majority of deals get done. For obvious reasons, construction lending is often relationship lending. So sponsors that have strong financial relationships with their banks, and the banks have an understanding of the sponsor's track record and wherewithal, can certainly be determining factors in whether or not they're able to get construction financing. But obviously, local lenders also typically have a very good appreciation for the market in which the product resides. So, nobody appreciates a local deal more than the lender that resides in that market. With that being said, over the last decade, we have seen some regional lenders come into the market with really national construction programs where they have taken it upon themselves to really understand the self-storage business, go out and identify the best-in-class operators, and then follow those operators around the country to develop. So, construction financing is a bank financing product. It's an SBA financing product, and then also a private debt product. So we have seen debt funds come into the market with stretch seniors or higher leverage product where they're getting paid a little more yield for the product, but are also taking a little bit more risk by climbing into the capital stack. So as we look at transitioning sort of toward bridge products are designed to fill the gap in transitional deals. So a product that has all of the construction, the building behind it, that's been completed, and now really we're just talking about leasing the property up, or even in some cases a deal that may be existing and cash flowing where there's an expansion component to it would fit in more to what we would call a bridge bucket. So those lenders are not wanting to administer construction draws or deal with the construction process. They're simply coming in and carrying the process, the product, or bridging from the construction, post-construction through stabilization when we would look at putting permanent debt in place. And the bridge market today has probably been the market that has been the most interrupted market by COVID. Prior to COVID, the bridge market, I think there were something like, and Steve, you might know this number, but I think there were 500 bridge lenders in the space. A mix, anybody can be a bridge lender. So a bank can be a bridge lender, a life insurance company can be a bridge lender, a debt fund could be a bridge lender. I think there's probably even a way, if we ask Nick or Terry, to apply SBA funds in a bridge scenario. So bridge financing is a bucket that we would define as transitional. It is an area I think that is particularly germane to the conversation today, because with all of the new supply that has been added to the market over the last 5 to 7 years, there are a lot of deals that have been constructed and are in lease up that may have not hit yet their projections or covenants, that still need more time because there has been a steady supply of new inventory added to the markets. So those projects may not be on budget or pro forma, and they would be, where they may have thought going into the project that they would be ready for permanent debt today, are finding themselves in the bridge bucket. And so in the COVID, prior to COVID, we had a very, very large number of lenders playing in the bridge space. What we saw through the disruption of COVID was a lot of those lenders pulled out of the market. So for various reasons, they either are having other opportunities, they've had their credit facilities withdrawn, margin calls, there's a variety of reasons why, but that pool of lenders has consolidated fairly dramatically. And then also, so you have less lenders bidding on probably the same amount of deals, which means that there's more competition for your deal. If you're out in the market shopping with a bridge lender today, they are looking at a lot of deals that they would compare to your deal, and they have the luxury today of cherry picking deals. So competition for deals has increased. It's tougher to find a bridge lender today, and the pricing for bridge money has gone up. So it is definitely more expensive than it was prior to COVID.
And Shawn, before we leave that point, if you were to compare pre-COVID versus where we are today, obviously every deal stands on its own and its underwriting, but if you had to give a range so that for the audience, so they have a sense of where rates are, because so many people have been going through the construction phase, are now in that call it that middle point in the life cycle of a deal where it's not yet stabilized and ready for long-term financing. Where are you seeing rates pre-COVID in the bridge space versus where they are today?
Yeah, so oftentimes a bridge product is going to be a floating rate, LIBOR-based product or a floating rate product. So the bridge market, as I said, prior to COVID was very, very competitive. There were a lot of lenders in the space, and they were competing for deals with each other. So they were less picky about the transactions they were willing to do, and that often translates to aggressive pricing. So we were placing bridge loans, and again, it's hard to paint, a deal with no cash flow that's in a very good market might price differently than a deal that's been open for some time in a smaller market that's been struggling to lease it. So it's hard to paint with a broad brush, but generally speaking, pricing pre-COVID was in the 250 to 375 over range. And I think today, while we're seeing a few lenders still play in a very competitive space, there's a couple of life companies and debt funds that are still pricing pretty aggressively. By and large, I would say the return expectations of the bridge lenders are up. So they would be starting at L+4, oftentimes with a 1% LIBOR floor, and up from there. And, people may ask, well, that doesn't make a lot of sense. But the reality is those same lenders have, it's always what's your next best alternative investment. So those lenders today have been presented with the opportunity to buy existing loans from lenders, other bridge lenders that are having to create some liquidity. So they're able to buy loans that have already been originated for a good deal. So that, if you talk to the bridge lenders that are in the market today, they would say it doesn't make any sense for me to lend under a certain yield because I have alternative investments. I can go buy investment grade corporate bonds. I can go buy existing loans. there are other things out there for me to buy to get the yield that I'm looking for. So I would say, generally speaking, more expensive, more conservative, starting at L+4 with few exceptions. So with a 1% LIBOR floor, you're talking about 5% rates and up from there.
Got it. All right. Thanks for that. So Dan, let's bring you into the conversation on this. You're coming at it from a different aspect, which is the rest of us are dealers, if you will, in the financing space. You're a user, and so tell us, for shifting again for our audience here, let's say you're coming into stabilization on your property. You're looking for long-term financing. The two of the main paths that people have historically gone have either been, life company debt or CMBS debt. Can you give us a little bit of an overview from a owner's perspective between those two? And have you been out there shopping for anything recently, where you can give us some color on what your experience has been out there in the market?
Sure. I think I can summarize some of the terms. We're not in the market actively right now. We've put a lot of our stuff to bed, really over the last couple of years. The environment was pretty good. So anything we had out there that was nearing maturity or any opportunities we had, we pretty much seized on the market and booked everything. So we're not active in the market for stable stuff right now. But getting to the initial question on how to compare a life co loan versus a CMBS, they're obviously both more stable property, longer term financing solutions. I think you need to break it down into what you're looking for. As an operator, I think you break that down into terms, documentation and process, and then at the back end, the servicing side of it. I think in terms of what kind of terms are you going to get, I think you're going to see the best terms from the CMBS market, given that the market is active and stable. We've obviously had a disruption in really all markets, not just CMBS, but CMBS really kind of shut down there for a little while. It's just kind of starting to get its feet under it again. And I think you're going to see, fixed rate, non-recourse is, what you're going to see with these products. That's what you're after with a more stable property. I think relative to the debt yield and loan to value requirements, you're going to see better terms in CMBS, and particularly in the interest only period. In a life company loan, you're not going to generally get 10 years IO like you would with a CMBS loan. Particularly in a good stable market. Life co can be competitive with rates, but again, the differentiator is usually what they're underrated to with those rates in terms of LTV, what kind of amortization is baked in that reduces the risk over time, and then the IO period is obviously a big piece of that. It also is determined on what kind of deal you're looking for. Are you looking for a large loan or a small loan? What markets are you in? The life companies tend to like major MSAs and generally not interested in smaller loans. There's a few out there that'll do smaller loans, but usually probably 15, 20 million is kind of a happy starting place for them. So in terms of terms, I think that's kind of where you wash out your decision making process. I think in documentation and process, life company process and documentation is a much simpler, straightforward process. CMBS is very rigid, as we all know. I think no matter what way you're going, whether it's construction debt, bridge debt, life, or CMBS, the more you can negotiate before you sign the term sheet and get baked in to the term sheet, the better off you're going to be. And you really have to think about what you want to do with the property or properties if it's a portfolio. Do you have expansion plans or modification dollar thresholds that you want to think about when you're documenting the loan? You'll see varying flexibility between life and CMBS, but your best bet is to negotiate it up front. Ability to pull properties out of a portfolio loan, earn-out concepts, what kind of assumability and prepayment. You're not going to get much flexibility in prepayment in a CMBS world where you might have a little more luck with that in a life company world. And one of the other things I always try to bake into kind of the term sheet phase is who's going to appraise it too. A lot of CMBS and life co is going to be very dependent on the appraisal. And while there's a Chinese wall between within the lender's shop, generally you can get them to steer it towards a national player with a dedicated self-storage practice, which you get a little more predictability in that realm. I think some other predictors would be rate lock is a big one in Lifeco versus CMBS. You're really kind of floating to the end with the CMBS. You're always going to be subject to the material adverse change considerations of what's going on in the market, i.e. COVID or 2008 housing bubble. So I think you have that, and there's going to be more risk of close in a CMBS market at terms than a Lifeco, which is going to stay on the balance sheet. I think in stable markets, you can see either loan move fairly quickly to close. I think a lot of that, again, depends on how much you get ironed out up front and you're not, trying to negotiate through the loan docs. A lot of it's already been predefined and you're just getting lawyers to document it. And then on the back end, I think, before you go into the loan, you should really be thinking about the back end and the servicing and asset management piece. With the life company loan staying on the balance sheet, the servicing is generally done in-house and it's a better experience. Although I have had, third-party servicers with life companies that, kind of takes away one of the big benefits of going with a life company. So if possible, I'd ask who's going to service the loan up front. Sometimes the CMBS shops do keep it in-house and you do have more of a relationship than the typical. Another big one is reporting requirements. Years ago, really coming out of the 2008-9, CMBS really started getting really rigid with reporting requirements, trying to put in monetary punitive penalties for failing to hit a reporting deadline, and their process on servicing is very much a check the box mentality, which can be frustrating as an operator, where their tracking systems aren't always the best, and it can be frustrating for your accounting department. And when you have annual lender inspections, with a life company, you've got an asset manager that's kind of looking at the report and determining, what's important, what's not, versus, a CMBS check the box mentality can, lead to more, every little thing on here has to be addressed, whether it's, a real issue or not. So I think that's probably a good high-level summary of the things to kind of consider with the two.
Great. Thanks, Dan. So we've got a question that's come in here that I'm going to read out to everybody, and this is a good question to transition to the next topic that I wanted to touch on. The question is, what's the rate of delinquencies that we're seeing in the CMBS market? I guess according to one economist, this person had read 7% of CMBS loans are now 30 days or more delinquent as of the end of May, and I'll answer that question. From the standpoint, my company, not only are we on the loan origination side of the business, but our sister company is one of the largest special servicers of CMBS loans in the world, and that's true. The delinquency rate and the rate of loans that have come into special servicing with requests has definitely jumped through the COVID period. Now, to give context to that, the vast majority of those assets are hotel assets, as you would expect. They're the first ones to get hit because they're nightly leases. And then the second right behind that would be retail, because so many so many retailers were deemed non-essential businesses as states were closing down. And so it put tenants in a situation where they weren't able to pay rent or they fell behind on it. So, but from a standpoint of self-storage, it has actually been remarkably stable. It's probably been the most stable performer of the asset classes, right up there with what you're hearing from multifamily, for example. So from a self-storage perspective in CMBS, it's been a great story. I want to take that and transition that into, let's talk about from a lender's perspective, given so many of the dynamic changes that have happened in the market over the course of the last 60, 90 days, that obviously plays into when a new loan is being originated and underwriting standards. And so let's go back through and let's talk about it from each perspective. I guess, Nick, I'm going to go back to you. We were talking about the 504 program with SBA. Have you seen any changes in the way loans are underwritten or reviewed in your underwriting process pre-COVID versus where we are today?
I'd say it's really comes down to the scope of the project. So for some of the larger facilities being constructed, like the over 5 million, 10 million, multi-level, I think the lease up period might take a little bit longer than your normal outdoor $1 million facility. So I think the larger facilities might be scrutinized a little bit more, depending on what market they're located in, just because I think the lease up might not hit the projections like it would have pre-COVID. So a little bit more scrutiny on the underwriting with lease up and cash flow projections.
Okay. I guess, Shawn, why don't you tell us what you're seeing out there? I know you shed a little bit of light, and part of it in being the universe within the bank and bridge loan space. Lenders have more to pick from, and they're a little bit choosier. Tell us what you're seeing from an underwriting standpoint for those people that are looking for bridge loans.
Sure. Well, I think it applies really not to bridge loans, but just all lenders in general. I think what we've seen is, one of the positives of, as you just pointed out, the performance of self-storage currently during the pandemic era, and really the performance of the asset class during the last recession. Self-storage has really woken a lot of investors up, and they have realized how resilient the product is. I think this pandemic is a great example because it was deemed a necessary business. We found a way to touch our customers without touching them through contactless rentals and the ability to stay open and stay relevant. And, the demand for storage isn't going to decline anytime soon. We were certainly in the prom court before, and I think now are in the running to be prom queen as an industry. I think people really appreciate where we're coming from. But with that said, one of the things that comes along with that as we become more institutional and are now fully institutional is there's more data available to the lenders than they've ever had before. So they are tracking markets. They have access to the new supply, to rental rates, to things that are going on in the market. And they are definitely asking questions. So it doesn't matter if you're out in the market applying for a construction loan, a bridge loan, or a permanent loan. Lenders want to understand what the downside scenario is. So they are asking for and conducting stress analysis. If it's a refinance, for example, of a CMBS loan from 10 years ago, it wouldn't be unusual for them to ask for, and we just closed a loan last week where the B buyer was asking for performance data from 2008, 2009, and 2010 to see how the properties were impacted during the last recession, and so that they could basically stress the underwriting. I think that lenders are today, if you're in the market, they're asking for a COVID appraisal. So if you had a deal that was put on hold pre-COVID, where you may have ordered the third-party report, it would not be unusual for a lender today to say that they want to have the appraisal updated or have a new appraisal ordered because they feel there might have been an impact to the cap rate. That's something that is an underwriting factor that lenders are looking at. They are certainly potentially looking at addressing the vacancy. Taxes continues to be a hot issue. That's not necessarily a COVID issue. That's just a self-storage 101 issue. But real estate taxes, as appraisers or as assessors around the country, have understood the value of the product. That is another area where we're seeing a lot of stress. So I think there's multiple areas that you could point to where lenders are finding a way to stress the cash flow. And that's largely a result of them just having more knowledge of our product type than they've ever had before.
Terry, Nick was just telling us, giving us color on the underwriting process from the 504 program. Anything in the 7A program that would differ from an underwriting standpoint, then versus now, pre-COVID versus post-COVID?
Well, not really. I mean, we look at, we do both 7A and 504, and we kind of look at it the same. We look at the underwriting very similarly, and some of the differences maybe, we have now that we didn't have before depends, or let's say it's an acquisition. Instead of just, the last 3 years of tax returns and financials, we want to see that plus financials up to the date that they come to us. And then we want to see, for from January till today. We want to see that, and then we want to see it year over year. I want to see that same picture from last year, so we can just compare how it's doing now versus then. So some things like that. If it's a new construction, we've always required a feasibility study from an independent third party, and we're going to look at that. We're going to have conversations with that expert. We're going to see what kind of information they may be using more conservatively now. Are they including any kind of increases in rent? Are they holding them flat? We're looking at that. That first year, if it's not going to open a year from now, but what about that first year? Are you including in your pro forma that you're going to have increases, or are you just going to go with what you're starting with? We're looking at that sort of thing. Because a year from now, it depends on, obviously we all know this, it depends on how long this thing stretches out, how long unemployment happens, because until all of the extended unemployment benefits are exhausted, will we get a real true picture. So we're just trying to be extra conservative on that end as well.
Hey Dan, switching over to from your perspective, I don't know if in the course of the last 90 days or so you've been in the process of whether you're looking for refinancing of an existing property that you already own, or if there's an acquisition that you've had in play during this time where you've been out looking for debt. What are you seeing from an owner's perspective in this market?
I think, I keep tabs on the debt market because I'm always looking to see if there's opportunities, for a refinance, or we do have some upcoming construction projects and things down the pipe that, I've got on my radar. So I keep in tune with the market. We're not in the market getting, bids right now. But, generally from the people I've talked to, which, as bankers, mortgage brokers, other operators within the industry, obviously, most of what I'm hearing is that there's a lot of lenders on the sideline right now. A lot of the banking relationships I have, when I talk to them, they're mostly on the sidelines. They're starting to get a little more active with things, but their underwriting is probably more conservative. The introduction of LIBOR floors, I think, was mentioned earlier. That's something that I'm hearing a lot of, is rate floors and things that are being baked into things. So I think there's those kind of metrics that are going in. There's also higher spreads. Spreads seem to have widened. So even though the indexes are down, the spreads are more than offsetting. As I think Shawn referenced earlier. So that's generally what we're hearing. There haven't been a lot of transactions that have closed in terms of like CMBS. Some of those closings and securitizations are just starting to get fired back up. So I think there's going to be, I think there has been good allocation to those things and subscription to the various pieces of the tranches of the CMBS securitizations, which should help longer term. But I think there's just a lot of uncertainty, and I think that's going to kind of constrain, a lot of, terms and things in the near term.
It's funny, I'll add a commentary onto what you were just talking about, Dan. We're in an interesting dynamic, at least from where I sit in the CMBS space, as it relates to self-storage, because in CMBS, our industry is really built around the crux of diversity. Is the sort of the name of the game in the product type of what we offer. So when I say that, I mean, each CMBS shop that's out there goes out and makes loans, some on self-storage, some on apartments, some on retail, some on hospitality. At least that's the way it was pre-COVID. And you deliver a package that is diverse in property type. But, the loans are diverse in property type, geographic diversity. Obviously there's diversity in having different borrowers, et cetera, and that's what that's what investors look for when they're buying CMBS. Now post-COVID, self-storage is sort of a benefactor of the fact that you were really not doing hotel loans right now because they've been impacted so hard from COVID. And retail is very difficult to do with just a looming uncertainty around, is there going to be another round of state closures, et cetera? And what is that going to mean for tenants and them paying rent? So it really kind of shifted the spotlight, when we're looking at new originations to self-storage, office, industrial, multifamily where you can get it. Fannie and Freddie are very aggressive in that market. So it's kind of almost put self-storage is on a little bit on a pedestal, if you will, in terms of of the property types that are non-retail, non-hotel. Self-storage has not only been, is one of those, but it's been a great performer as an asset class through this. What do you? I'm going to go back to Dan for a second. What's your gut on cap rates? Where do you think? Where do you see this heading? Because obviously, back to the conversation around underwriting, that's going to play into appraisals, and appraisals are always backwards looking because they're looking at data from transactions that have occurred, and we haven't had a lot of transactions, during COVID for them to be able to look back on and use as data points. So, if you're somebody that's in the market thinking about getting financing, whether that be a shorter term program or getting permanent financing, the appraisal is going to be a huge part of that. Coming out of it, what's your predictions, Dan, on where you think appraisals are headed? Really cap rates.
Yeah, I mean, I think it's a tough question to answer. Right now, with the disruption in the markets, but I think from what I've heard and seen, and my gut is right now things are holding steady in terms of cap rates. There's not a lot of other data out there. You've got a ton of stimulus entering the economy, offsetting things. And so I'm kind of speaking specifically to self-storage. We, as you were referencing the diversity in loan pools, in a self-storage facility, you have a lot of diversity in your tenant base, and that's part of what has contributed to the long-term, very low default rates in CMBS self-storage relative to other asset classes. Typically it's performed very, very well. Always best in class in terms of CMBS default rates. So I don't think appraisers, as you said, are backwards looking. They're always trying to grab a comp to point to, and since there's not a lot of activity, I think what I've heard from appraisers I've talked to is generally they're holding cap rate. They're not moving cap rate out. They are more sensitive to rental rate. And trying to peg that and how long it'll take to achieve a rental rate, if there's any upside in that rental rate that is needed for performer or something like that. So I think as of now, I think cap rates are steady. You've got very low indexes and things kind of holding things down on that end, and then you've got some huge macro issues going on right now with unemployment and things that are kind of pulling the other direction. And I don't think the markets have really figured that out, and I think it's going to be a while before that really shakes out.
Yeah, Steve, if I could jump in. I'm not, I think what we're seeing is definitely to what Dan's alluding to. I mean, look, if you take a step back and you look at the amount of liquidity that's been pumped into the system since the pandemic, and really stemming from the last recession, which we haven't dug our way out of that hole, there is a tremendous amount of liquidity in the market that's seeking real assets, and our asset class right now is one of the few that is, as you just pointed out, standing above the rest. So the demand for self-storage and investment into self-storage isn't going to slow down anytime soon, and I think you're going to see that that's going to keep cap rates very, very low. I think where we're seeing, to the question about underwriting and also the question about valuation, which is really when we're talking about cap rates, we're talking about valuation at the end of the day. I think what we're seeing is lenders are pulling back. So, if they were a 70% or 65% lender yesterday, they may be a 55 or 60% lender today. So the easiest way to haircut or to stress a deal is to simply pull back your leverage, to add structure, to do things to the loan that enable you to feel that you have more credit support in place. And that's really what we're seeing lenders are doing. I mean, you might be able to talk about this specifically to CMBS, but I think that borrowers can expect to see quite a bit more structure coming into CMBS and really for at least a period of time until we sort of reach equilibrium. That huge cash out full term IO deal probably isn't going to be there in the near future. Can you get a few years of IO? Sure. Can you get some cash out? Sure. Can you have it all? Maybe not. And you may have to be prepared to escrow 6 to 12 months of debt service payments on that loan because the lender is going to require more structure. So, you can impact the valuation in other ways than altering the cap rate simply by underwriting to a more stressed analysis and then capping a reduced cash flow at the same level.
Yeah, which is absolutely. Which brings me to, I was going to ask, the next question. Shawn, I'll ask you. From where you sit, so many people. If you're a property owner that has optionality in the timing of, hey, I've got a property that needs financing, whether that be a bank loan or bridge loan that's shorter term, or maybe you're looking to roll into a stabilized product for a longer term loan. There's the people, do I finance now, or if I've got a little bit of time on my hands and optionality, do I wait a little bit longer and finance, look to finance 6 or 12 months from now? It's a little bit of a, so many, I hear from, a couple of different, folks that I've talked to in the last, 2-3 weeks. Some people say, I'll wait, I'll wait 6 months and I'll see where the market is then. Now, that was, I played devil's advocate. If you were a retail owner or a hotel owner and you were saying that 6 months ago, you're really kicking yourself in the ass right now for having done that. So, what's your words of advice from your crystal ball?
Well, I think and I'm not going to try to be elusive. It is definitely a depends question. So right now we're seeing in the permanent debt market a tremendous amount of liquidity for the best deals. So if you are a borrower with a very low leverage, refinance, high quality borrower, high quality market, those bids are very, very aggressive because the lenders that are in the space are all looking for those deals and will bid those deals very competitively. But generally speaking, and this is not a self-serving comment, certainly it goes against, our business is refinancing and acquiring properties. But on the acquisition side, there are going to be some opportunities for sponsors that are in a position to take advantage of, and those obviously are not optional transactions. If you want to buy a deal, you're going to buy a deal, and you're probably going to need to put financing in place around. If you're an optional refinance, somebody that's in the market today simply, looking to transact because you're just wondering what's out there, I think you really need to assess your own individual situation. It never hurts to go into the market and shop. And there are certainly lenders that are going to bid the transaction. Whether or not you like the bid is something that will be determined, and the market will decide that. That's really the benefit of going to market. Using a service like ours is you get to see multiple bids from multiple lenders and really have an understanding of where the market is. If the bid works for you, then certainly you're taking some risk off the table if you're able to transact today because the rate environment is very low. With all that said, make no mistake, we are in a lender-friendly environment today. The lenders have the deck has been shuffled back to them, and they have the opportunity today to put structure in place around deals and to really execute at more lender-friendly terms than they had certainly 6 months ago. And the other thing, we don't know, the COVID isn't over yet. If you look at the news and look at what's going on, because we've all woken up and decided that we're fatigued, we're quarantine fatigued, has not meant that this thing has gone past us. And so, what's going to happen this fall is anybody's guess. And I don't think we have another $3 trillion to pump into the system if we decide that it's a lot worse than we thought it was going to be. So if you have a loan maturing in the next 12 months, there's no guarantee that the lender environment is going to be better in the fall or better in the spring. If you have all the time in the world, then I would say that, why subject yourself to a lot of risk today? Because just because a lender signs up a deal today doesn't mean that if the market is materially different in 45 days that they might decide to change the terms of the deal or pull out of the market. So I think you really have to assess your own individual situation and determine if it makes sense to transact.
So Nick, what's your party line here? Are you six months from now, 12 months from now, rates the same, lower or higher?
I would say it'd probably hold tight for a while.
Okay. How about Terry? What about you? What say you?
I left my crystal ball in my office, and I can't tell you. I think it's gonna hold on, for a while. I don't see much in the way of changes personally at the moment.
Yeah.
That's my guess.
Good deal. So Dan, you're sitting on the other side of the table from this, being on the ownership side. What are your thoughts? If you're sitting there and you got to make a decision, you've got optionality in your favor of do I do it now? Do I wait a little bit and do it later? What are your thoughts?
Yeah, I would agree. There's no crystal ball. This is totally unprecedented. I think it goes back to what Shawn said. If you need to be in the market, I think the sooner you get in before a huge disruption event occurs with a second wave and consumer confidence shaking and things like that. It's probably, if you need to be in the market, I think I'd be in the market. I'd take a wide survey of the market, as Shawn indicated. I think if you've got time, I think there's so much uncertainty, relative to closing and whether you're going to close on terms and things right now that I'd be pretty hesitant to be signing up a term sheet and thinking I'm going to close. One, I think closes is going to take longer than typical. If you can close a loan in 45 days, I think it's going to take longer. And I think you're subject to a lot of appraisal risk and things that you wouldn't be subject to in a more stable environment.
So we've got a question that's come in here for all of us to discuss, and we've touched on it a little bit, but have we seen a trend to reduce the amount of proceeds, and has there been significant retrading from term sheets as a result of just what's happened in the economy? Obviously specific to CMBS. So we'll take it around, and so Terry, I'll start with you. On the SBA side, on the programs, on the loans that you've been seeing getting them approved, what's the trend been?
There's not really been any difference in the amount of proceeds. What we've looked at more is the liquidity of the borrower, just to make sure that later down the road, if there's any kind of an issue, that they'll be able to cover it or take care of it. But the only other time we've looked at maybe reducing proceeds is, we do an occasional conventional loan, and we're wanting a little more equity in the deal at that case. And I'd like to throw one thing in, if you don't mind, before I forget to mention it. If you currently have an SBA loan, you're a fortunate person because you're getting 6 months of payments made by the SBA. And currently, under the CARES Act, the SBA is required to make 6 months of P&I payments for any loan that closes closes and fully funds between now and September 27th. And since that's a Sunday, let's say the 25th, but that's really only going to work, if it's an acquisition deal that it can be fully funded. And really, it's only going to work if it's a 7A right now, because trying to close and fully fund a 504 is pretty much virtually impossible at this point. But I want to throw that out there for anybody who's in the market right now. You may be able to take advantage of this. I mean, this is unprecedented, and you may not see anything like that again in the future. Right. And I apologize, Steve, for hijacking that, but I didn't want to forget that in case there's somebody out there that can take advantage of that.
No, call now in the next 10 minutes, and Terry will throw in a free toaster.
Yes, I'll throw in 2.
Yeah, exactly, some Rubbermaid as well. Nick, what about you?
Yeah, we really haven't changed the way we price or do our sources and uses. So we've tried to be business as usual during this whole process. So nothing major, no major changes.
Shawn, you've touched on it a lot through your commentary throughout the course of the last hour. What your takeaway message for folks in terms of the change through this and in proceeds?
Well, I think, Steve, you can appreciate this more than anybody. It really depends on the health of the CMBS market. So going into the pandemic, the first thing that happened was the CMBS, the capital markets, shut down. They provide so much liquidity to the market, to all the lenders in the market, that really did send a shockwave through the market. And the immediate reaction was it really depended on if you were dealing with a balance sheet lender or a lender that sells loans into the secondary market. Certainly lenders that were selling loans into the secondary market, or bridge lenders, debt funds, people that are relying on other people's money or a secondary execution, pulled back for sure. Fortunately, we had several transactions that kind of got hijacked by the market, and we were able to put those back together using balance sheet lenders, or as the CMBS market started to come back, which it is now, functioning again, and let's hope that that remains, because that's good for the health of the market. If I had to say generally, I think lenders have taken a little bit more of a conservative mindset, and that's just because the pool of lenders at this point is smaller. There are, if the spigot was operating at 100% in January, in March or April, it was operating at 25%, and today it's probably operating at 50 to 60%. So there's less lenders in the space than there were, and that creates a situation where lenders can be more conservative because they've got the ball. So that's kind of where things are. But the reality is we had a transaction go sideways in the beginning of COVID. We closed it last week at a low 4% range with multiple years of IO at 72% of cost. That was a CMBS execution, $30 million loan, $31 million loan. So, I mean, how upset can you be when you're getting 3 years of IO at just over 4% in a post-COVID world, or, a pandemic world? I think that's still very, very competitive financing.
Well, guys, I know we're coming up to the end of our time here. I do want to remind the audience, just so that everybody knows, if you've got questions or things that you want to discuss, I know we all have booths. We'll be part of the virtual trade show today. Feel free to stop in and speak with each one of us respectively. And we're happy to answer your questions, go out and do breakout sessions, which is kind of a cool feature that we can do, as part of our virtual trade booth. Just like if we were in person, we could step off to the side and have a direct conversation, or set up a time, outside of the conference to meet by phone, or communicate over email. So please make sure you take advantage of that, and we look forward to meeting folks along the way today. And thanks to our friends at SBOA for putting this on, and for all of you guys for participating. So thanks very much, and looking forward to seeing everybody in person real soon.
Thanks, Steve.
Thank you.
Thanks.
Thank you.